Greetings from Oxford. I'm Howard Rogers, the Director of Natural Gas Research at the Oxford Institute for Energy Studies, and I'd like to share with you some of the insights and conclusions from my paper published in early July entitled "The Impact of Lower Gas and Oil Prices on Global Gas and LNG Markets." So please download the slides via the link on the website, which I will refer to in this short talk. As shown in slide 1, the period spanning 2011 to the end of 2013 witnessed distinct price corridors for key regional gas reference prices, specifically Henry Hub $2 to $5 an MMBTU, European hubs $8 to $11 an MMBTU, Asian LNG contract prices linked to oil $15 to $18 per MMBTU, and Asian LNG spot prices in the corridor $13 to $19 an MMBTU. So in the expectation that these price levels would continue and that the significant spread between Henry Hub and Asian and European gas prices would be maintained, the LNG players embarked upon developing numerous LNG supply projects with the aim of bringing them online before the competition. However, reduced winter natural gas demand in Europe and Asia in early 2014 and a perception that Asian LNG demand growth was slowing led to a reduction in European hub and Asian LNG spot prices in early to mid 2014. The collapse in oil prices in October 2014 has driven down Asian LNG JCC linked contract prices and has effectively put on hold FIDs, that's final investment decision, on many LNG projects which would otherwise have moved into the construction phase in 2015 and 2016. This said, some 85 BCMA of Australian LNG projects which have gained FIDs between 2009 and 2012 have or will come on stream between 2014 and 2018. And over 80 BCMA of US LNG export projects are under construction, the first such facility expected to commence exports at the end of 2015 or early 2016. The impressive scale of this next LNG growth wave is shown on slide 2. While historically the low energy density of gas has tended to keep regional gas markets separate due to the cost of transportation and storage, the growth in LNG trade has had the effect of increasing the connectivity of a system which I represent schematically in slide 3. So LNG supply, whether from established sources or post-2015 from the US, will tend to meet demand in Asia and new markets, with any excess seeking a market in Europe. Russia, being the only participant in this system with excess productive capacity, tends to be the swing player or shock absorber. However, there are large uncertainties over the future trends of some of the elements in this system, and on slide 4 I list the 3 key demand side uncertainties: Asian and particularly Chinese LNG demand, new markets in the 2020s, especially LNG as a marine transportation fuel, and European gas demand recovery. On the supply side, we have the future scale and pace of US and non-US LNG suppliers, especially given the uncertain future pricing environment. And thirdly, how Russia chooses to respond to future competing supplies in Europe. So using a quantitative model based on the schematic in slide 3, we can explore the 4 basic demand combination scenarios as I've shown simplistically on slide 5. But for these, we have to make assumptions as to the behavioral responses of the 2 key supply side participants, namely Russia and investors in new LNG projects. But this is not without complexity. Russia has the ability to change its business model in Europe to one which I show in slide 6, which I've called the hub redelivery model. So by adjusting the mixture of physical gas it flows from West Siberia with volumes of gas it buys from European trading hubs, it can meet customer contract nominations but also directly influence the level of European gas hub prices. In this mode, Russia could choose whether to increase physical exports to Europe to keep hub prices and by arbitrage Asian LNG spot prices below the level to move new LNG projects to FID. Alternatively, Russia could reduce physical exports to Europe, raise hub prices, and in doing so, encourage the development of new LNG projects and hence competing supply for the European market. In the paper, such scenarios are explored in some quantitative detail. While this new great game dynamic is certainly possible and has a compelling logic, there is scant evidence in mid-2015 that Russia is immediately contemplating such a course of action. However, its hand could be forced if A, its buyers continue to nominate high volumes in order to sell some of this on the hubs in Europe and hence stimulate gas demand, always in the belief that concessions and rebates from Gazprom would keep them financially whole, or B, if a surge of European LNG imports takes hub prices down to levels which either Gazprom deems too low or where its midstream buyers, unable to meet take-or-pay requirements, demand further substantial contractual concessions, including perhaps in extremis contract termination. From a more positive perspective, more flexible use of spare West Siberian production capacity would moderate a potential early 2020s tight LNG market situation, perhaps caused by a sudden acceleration of Asian LNG demand. From a less positive perspective, Russia's market power would, in this system, extend beyond Europe. The impact of higher or lower physical Russian flows would certainly impact European hubs and also, by arbitrage, Asian LNG spot prices. But in certain circumstances, for example, overbuilt US LNG export capacity not fully utilized, European hub price levels could also, through arbitrage, influence the Henry Hub price, especially if US LNG exports continued on the basis of covering just variable shipping and regas costs. For this to happen, however, we would probably have to assume disappointing US shale gas performance, which at present does not seem likely. The moderating factor, however, is that if Russia maintains European hub prices at levels high enough to trigger new LNG FIDs, this would create competing supply, which once built has very low variable costs and will tend not to respond to subsequent lower prices, except very extreme low prices. However, the lack of clarity on Russia's future preferred commercial behavior adds a level of complexity most market participants would prefer to ignore. Gazprom is occupied on many fronts in both political and commercial spheres. At some point, however, the need to adopt a more market-orientated strategy is likely to rise on its list of priorities. While the timing of this is at present uncertain, the conclusions of this paper would strongly suggest that this is a development that players in the wider LNG-connected global system should be closely monitoring. I hope you find the paper useful and interesting, and I would invite you to explore our list of published papers, all free to download on our website. Thank you for your attention.